In this video, we break down the exact mathematics for calculating spread outcomes. Before you enter any multi-leg position, you must quantify your boundaries. Unlike buying a single stock where risk can be vague, defined risk option spreads allow us to know our exact best and worst-case scenarios before execution. We do this by analyzing the relationship between the strike width and the net premium paid or received. Let's use a bull call spread, a debit spread, as our primary example. Assume the underlying stock is trading at $100. We buy the $100 call and sell the $105 call. The distance between these strikes is $5. This is the strike width. If we pay $2 to enter this trade, that amount is our net debit. To calculate max profit for a debit spread, we subtract the net debit from the strike width. The market cannot pay us more than the distance between the strikes, and we must recoup our entry cost. In our example, a $5 width minus the $2 cost results in a maximum profit of $3 per share, realized if the stock closes above $105. Max loss is straightforward for debit spreads. It is simply the net debit paid to enter the trade. If the stock drops below our long strike of $100 at expiration, both options expire worthless, and we lose the premium paid. For credit spreads, the math inverts. Your max profit is the credit received, and max loss is the strike width minus that credit. Finally, we evaluate the risk-reward ratio. Using our example figures, we risk $2 to make $3, giving us a 1 minute and 1.5 seconds risk-to-reward ratio. Successful traders use this ratio to determine position sizing. If the potential reward does not justify the risk based on the probability of profit, the trade should be skipped. Master these calculations to ensure your risk aligns with your trading plan.